Tesla announced earlier this week that they were laying off about 10% of the workforce, and the stock market hasn't really had a huge reaction, but I like to put layoffs in two different categories. Sometimes there are good layoffs when a company is reducing their operating expenses. For example, Spotify did this. They cut some of those operating expenses to try to get more of their gross margin to flow to the bottom line. And a year later, Spotify's growth wasn't impacted, but their margins were impacted. So that was the example of a good layoff. Keep your engineering, cut your sales and marketing, more of your revenue is going to flow to the bottom line. But there are also bad layoffs. And these are layoffs that indicate that there is weak demand for your product and that you fundamentally need to change how much money you're spending in your business. I think what we're seeing with Tesla right now is demand is fundamentally very weak for their vehicles. So I want to go through a few of the numbers, and with their earnings coming up relatively quickly, go through what we should be looking at from their income statement. Because this is going to be a really volatile quarter, very pivotal quarter for the company, because the stock is still significantly more expensive than a lot of its competitors in the auto industry. And so this company and their financial results start acting more like an auto company and less like a technology company, which has very high margins, very high growth rates, then we could see that multiple come down to more in line with competitors. I still think that Tesla could trade at a premium. That would make a lot of sense, but not the 10x premium that we have today. So I want to cover the most important numbers to know today. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. The first thing to highlight is the information we got recently about production and deliveries. The red line that you see here is total production on a quarterly basis. The blue line is deliveries on a quarterly basis. I went back to 2022, and the reason that I went back that far is because that was when I started covering Tesla lowering their prices. That was when they started to implement a bunch of incentives to try to move more vehicles, and I thought that that was a sign that they were having demand problems. If they were having demand problems, the next step would be lowering prices further, having other incentives for people to actually buy more vehicles. And it turns out that's exactly what happened. You can see that deliveries in the fourth quarter of 2022 were actually higher than they were in the first quarter of 2024. Now, there are a bunch of things that can happen in a quarter-to-quarter basis, but Tesla went to a lot of effort in the US and in China to try to lower prices in the first quarter of 2024. So they were clearly trying to sell more vehicles. They also had significantly higher production than the number of vehicles that they sold. And that's the next number that we want to keep in mind. Because if you're not selling all the vehicles that you're producing, you start building inventory. And that's exactly what you see here is inventory building throughout 2021, 2022, and then it's maintained a relatively high level throughout 2023. I think what we saw with those delivery numbers is that in 2024, to start the year, we're probably going to see inventory rise again. Why is that inventory number important? Inventory is important because when inventory starts increasing, then companies have a couple of options for what to do and how to move their inventory. They can reduce their production, or they can reduce prices and as a result, reduce margins. And this is exactly what Tesla has decided to do. Until relatively recently, they were maintaining their production goal that they wanted to grow production and deliveries by 50% per year, at least on a unit basis. So they wanted to keep production growing. They said, hey, maybe we'll just lower prices, have a little bit lower margins. But you can only do that so far. And you can see from that chart that I just showed that operating margins and gross margins are now getting to dangerously low levels. I think in the first quarter of 2024, we're probably going to see those margins fall below some of the traditional automakers. This is what Tesla always argued, was that they were more profitable than traditional automakers. I don't think that's going to be the case in the first quarter because of all the discounting that they've had to do to move product. And now you're getting to the point where this is no longer a growth company and it's no longer a high margin company. That becomes really important when you start to look at valuation. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. The first thing I want to do is show the price to earnings multiple of some of the big automakers. Right now, Tesla's price to earnings multiple is about 36. And now this is on a trailing 12-month basis because these are numbers that we know. I'm not going to use forward numbers because they could be wildly different from what Tesla actually reports. Some of their competitors are significantly cheaper. Ford trades for a price to earnings multiple of 11. GM has a price to earnings multiple of 6. So these are significantly cheaper stocks on a price to earnings multiple basis. But price to earnings multiple might not be the right metric to use when comparing these companies because they have a little bit different profitability. So let's look at price to sales. If margins for these companies start to come in line with each other and everybody's basically commoditized in the market, price to sales is going to be a much better metric to look at. And on this basis, Tesla is more than 15 times more expensive than its competitors. Current price to sales multiple for Tesla, 5.3, and both Ford and GM trade for about 0.3 times sales. That is just a massive difference in valuation between Tesla and some of the legacy automakers. And this is a huge concern if we start to see Tesla's margins and profitability become more in line with some of their major competitors. And I think that's exactly what we're seeing. And the reason that we're seeing that is because supply and demand is fundamentally the most important thing in the auto market. You need to have demand for all of the vehicles that you're producing so that you don't have to discount them and you can make enough money to be a profitable business and ultimately return money to shareholders. But Tesla is moving in exactly the opposite direction. These changes that they made over the past couple of weeks, reducing the price of FSD, cutting their headcount, are really showing that demand is going to be the problem for the company. And if demand is a problem, profitability is ultimately going to be a problem. And if profitability is a problem and you're not growing anymore, now you don't deserve the same multiple that you had from a stock standpoint. And if Tesla's stock is 10 to 20 times more expensive than the competition, depending on which metric you want to look at, that means there is a massive amount of downside for investors. I am not in any way arguing that Tesla shouldn't trade at a premium to some of the legacy automakers, but I am arguing that that premium probably shouldn't be 10 to 20 times where they're trading, especially given the current trends for Tesla's business. The trend is that Tesla's deliveries and sales are on decline. The trend is that Tesla's prices are on decline at the same time. Their margins are on decline. We are not seeing the same negative trends for traditional automakers. There is plenty of demand for trucks and SUVs, some of the compact vehicles that they're making. GM said earlier this month that their deliveries to retail increased 6% in the first quarter in the US. So it appears that this is an EV specific problem and a Tesla specific problem. I just think all of these numbers are things that investors need to think about going into earnings season because earnings may be much, much worse than we thought. And not only were the delivery numbers a red flag for Tesla investors, but the next thing was the layoffs. When Tesla is laying off 10% of people, that is a massive red flag and tells you that that's going to impact every part of the company, including production workers, which are not something that you do if you're just trying to make the business more efficient. So we'll see what first quarter numbers look like when those come out. But let me know what your thoughts on Tesla stock is going forward. Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.